Hey, it's Jim, and this is level 1 of the CFA program, the topic on alternative investments, and the learning module on investments in private capital equity and debt. Let me begin, as I regularly do, with a simple story of economics. Let's suppose that I'm Jim, and I'm a Honeycrisp apple farmer. And I spend lots of time and energy and resources and capital on planting and harvesting and pruning and deworming. And I bring these apples to the market, right? I'm supplying the apples. You guys, on the other hand, you love Honeycrisp apples, so you're the demanders. So you come to the market and we agree on a price. And that's clearing price, supply equals demand. You're happy and I'm happy. But let's suppose that I want to expand my operations. I want to buy some land way over there, and I need lots and lots of equipment to grow some grapes. And ultimately, I want to start manufacturing Honeycrisp apple wine. Well, I need a bunch of capital for this. So what can I do? I can go to the bank, and the banker might say to me, you know what, Jim, there's a lot of wine manufacturers out there. Honeycrisp apple wine, I don't know, it doesn't sound very good. Here's some money, but I'm going to charge you a high interest rate. Some banks might just say no. Well, I could go to my friends and family members and say, how would you like some ownership in this new venture? And they might look at me and they say, you know what, Jim, you're 62 years old. You're just not quite the man you used to be. Whatever. So they say no. Now, wait a minute. You guys not only are Honeycrisp apple consumers, you potentially are Honeycrisp apple investors. So you're now supplying the capital to me. So all you have to do is come to my farm and say, hey, Jim, we have a bunch of money. We're happy to lend you this. You're a great Honeycrisp apple farmer. We think you're going to do great with grapes and do great with Honeycrisp apple wine. So you could provide me with a loan. Some of you might say, hey, Jim, here's a bunch of money. It's a regular old 5 or 10 year loan. Some of you might say, you know what, Jim, we want an ownership. We want ownership in your new venture. And so I say, sure. We'll be part owners as we go through this process. So some of you provide me with debt, some of you provide me with equity. This is private capital. This is an arrangement between you and me so that I can expand my operations. Now, of course, this is a simple example. And in order for us to execute both of these contracts, we probably need thousands of lawyers in there. So this learning module is really nothing more than an application of the supply and demand conditions that I just described, layered with the legality of how do we do this privately? Because you're not willing to lend me this capital without some kind of a contract. And that's pretty much what this learning module does. But remember, no matter how fancy the terms are, no matter how complex some of these arrangements become, it's really just you lending me, Jim the farmer, some equity or debt so that I can expand my operations. So look at these LOSs, right? Features, and diversification benefits. You might have noticed that there's some overlap, maybe a substantial amount of overlap in these learning modules inside of the alternative investment topics. But every single one of the learning modules has some mention, some emphasis, and even a learning outcome statement on diversification. So remember, no matter what you are challenged with on the exam, whenever you're talking about and tested about alternative investments and diversification, always think correlation coefficient, and just put in your brain correlation coefficient between most alternatives and traditional debt and equity is probably close to 0. All right, here is a good first slide that I just described with my Honeycrisp apple example. Private equity, private debt. Yeah, this makes perfect sense here. All right, so let's start with this first LOS. What are some features of private equity? All right, so what does this mean? How many different ways can investors out there gain access to companies that are privately held? Well, historically, at least going back to the 70s, let's say, maybe even some back into the 1960s, what a group of investors could do is get together and issue a bunch of bonds. Maybe it's some kind of debt, whatever it looks like, and then use those proceeds to go ahead and take over a company. Excuse me. That's why these things are called leveraged buyouts. Leverage means the use of debt. So a private equity firm, and by the way, let me go ahead and just, hopefully I'm not offending you, but make sure you understand that a private equity firm operates just like a mutual fund, just like a hedge fund, except there are some extreme differences. But essentially, what a private equity firm does is just ask people to send them money. Hey, all you investors out there, just send me your money, just like a mutual fund manager does, just like a hedge fund manager does. But a private equity firm, they're probably going to say something like, you know what, don't send me $5,000, send me $5 million or $50 million. And what we're going to do is we're not going to go out and invest in Johnson & Johnson or Procter & Gamble. We're going to go invest in Jim's Honeycrisp apple orchard, privately held firm. So the use of debt, that's this whole leveraged buyouts. Now, sometimes the managers are involved. I mean, I could stay involved, right? I guess I'm the owner of Jim's orchard. I'm the manager. I run it. I guess I could stay involved after I'm taken over, or I could get out if I don't want to be involved. So there's the two down at the bottom there, a management buyout or a management buy-in. And so typically what happens is that, now remember, some of you were going to provide me with a loan, some of you were going to provide me with equity capital, and so what kind of collateral is there involved? Well, for those of you who provide me with a traditional bond or a traditional loan, I'll go ahead and put my Honeycrisp apple trees as my assets. That'll be the collateral. But then for those of you who provide me with equity capital, I'll go ahead and say, well, you know what, I sell the Honeycrisp apples. You'll have a claim on those cash flows. So that's exactly like it is for publicly held companies. Now, what's the goal of this? Of course, this leveraged buyout, you come in, you take over the company, and then you think you're better at it than the current managers, or you think you can improve the current management team, whether it's a buyout or a buy-in. So look down at the bottom there, improving revenue, operations, increasing profits. But what I always focus on, and you should know this from listening to me over all of these learning modules, is the focus ought to be on cash flows. Remember our conversations about Modigliani and Miller? They taught us that the value of any company depends on two variables: the quality of the assets, and I always say the ability of the firm to generate sustainable operating cash flows, and then the weighted average cost of capital, or what are the level of interest rates out there. Now, venture capital is I always think about venture capital and private equity and hedge funds. I kind of lump them all together, even though they have some distinctly different characteristics. Think about private equity. In general, these managers are going to invest in established companies. But venture capital, these are private companies that are just in the beginning stages in general. So think of venture capital as the beginning stages of the process. Although what happens then after that beginning stage starts selling their product, then there are later stages to provide extra capital. So here's a good slide to memorize here. What we can do is we can finance at any stage. So pre-seed, angel financing. You guys know I always send you to the questions at the end of the learning module. The very first question has angel financing as one of its possible answers. I think it might even be the correct answer, actually. So what does that mean? You have the idea, the brain. So this would be me waking up one day and say, hey, I would like to be a Honeycrisp apple farmer. I don't have any land. I don't know anything about Honeycrisp apples. So there's the idea, and I come to you and say, hey, can you lend me $50 million or whatever it is, right? So then once I get that pre-seed or angel financing, then what do? I buy some land, I buy some equipment, I buy some Honeycrisp apple seeds. No pun intended right there. So what does that do? Product development, marketing, then early stage and startup stage. So this means that, hey, I'm going to start growing the trees. Now, of course, tree growing is a little bit different. Maybe I could can you buy mature Honeycrisp apple trees? I don't have any idea. Later stage financing. So notice the key there. This is before an initial public offering, and then there's some mezzanine stage financing. So just think of these steps as the different stages under which the investor can provide capital to a growing company. Now, growth capital, this sounds an awful lot like we were just talking about, and in fact it is, but what we're doing here specifically with growth capital is, look at that, the bolded over there on the far right there, minority equity investment. So we're not interested in taking over Jim's orchard completely, but we're interested in Jim, in partnering with Jim. Maybe we'll buy 10%, maybe we'll buy 20%, whatever it is. And so look at this, expansion or restructuring, venturing into new markets, funding significant acquisitions. So this makes perfect sense in my Jim's Honeycrisp apple orchard. Now, some of these companies out there, these public companies, they can seek equity capital through private arrangements. So these are called the PIPEs, private investment in public equities. And so this is just really kind of like a fun, it's almost like, don't quote me on this, almost like a mutual fund. But look at those bullet points down there. These are probably the good exam questions. Fewer disclosures, lower transaction costs, and it can be dilutive. That makes perfect sense. Here's a little bit of a review of what we did in a previous learning module, right? Direct investments, indirect investments made through a fund of funds. And so, the difference between those two and the fund of funds vehicle is that, it's kind of different layers or different levels. In that direct investment, you probably need lots and lots of capital. Through an indirect investment with a fund of funds, you probably need less capital. And then you can do this concept of a co-investment. You can invest in the private equity fund that does all this stuff, but then you can co-invest over here. Suppose I make up a private equity firm that invests only in farmland and orchards. And so you can invest in that. And so part of that portfolio is Jim's Honeycrisp apple orchard. And so there's an opportunity for you to invest in the portfolio, but you could also co-invest directly over here in my firm. So what we just described is, how do we get into this stuff? How do we enter this private equity market? Well, we want to enter and we want to invest in high growth firms, right? We want to buy low and sell high. We're still interested in getting dividends, but we're mostly interested in capital gains. And that's a good point of emphasis in the beginning of this learning module, is that, private equity firms, you might get a dividend, but that's really not the focus. The focus is buying in at 100 and then 5 years later selling it at 1,000, So how do we do this? We can do a trade sale, which is very similar to when someone dies and you have an estate sale. So people come into the house and they say, I want to buy that desk. I want to buy this thing over here. And so you arrange it through some kind of an auction or a private negotiation. And so what do you think about this? There's lots and lots of liquidity in there, fast and simple, lower transaction costs. And if it is an auction, there's the potential for the high purchase price. I hear these stories of my colleagues having their parents pass away and have, an estate sale. And inevitably, there is something in the house that two or more people want, and so they get into kind of an argument. What is that called? Not an argument, but a bidding process. So there's always the potential for a high purchase price. When I go, I always tell my children that I don't buy hardly anything for myself, but I do like socks. So I tell my children that, I want you to put my socks in a big old portfolio, and someone's going to say, man, these are really, really cool socks. I'll give you $1,000 for those things. And my children, they just nod and say, okay, Dad, whatever. All right, so what are some disadvantages here? So think about me and my orchard. I might not be in favor of some kind of an auction. There might be limited number of buyers. And you have to think about this thing for this low attractiveness for portfolio company employees inside of this private equity firm, who may say something like, hey, you know what, if we went another area like an IPO, we might get a higher price. So here's this higher price, or this potential higher price, this initial public offering. I'm guessing you know all about IPOs with your experience. publicity for the private equity firm. And by the way, this is a question at the end of the learning module. What are good things about, what are similarities? And so one of them is the publicity. You have an IPO and it shows up in the Wall Street Journal. So everybody is attracted to it and they think, oh my gosh, there's the IPO price, $18. Oh my gosh, I have $18 laying around. I'll go ahead and buy that. That should be no problem, right? So potential for high price, managerial approval. What are the advantages? The disadvantages? Well, all you have to do is think about the government. And there are always extra people involved in these substantial transactions. And so the government says something like, you know what, for you to have an IPO, we want you to fill out all of these forms. And there's 12 million forms that you have to fill out. So long lead times, disclosure requirements. You might not be able to sell your shares for 10 days or 20 days or 20 years. High transaction costs. I always quote these to my students, and they're relatively accurate. The investment banker charges for a fixed income security offering, 6 or 7 or 8%, and then maybe 11 or 12 or 13% for an initial public offering. So paying investment banks and lawyers, that's super high transaction costs. Now remember our conversations in a previous learning module on a special purpose entity. Remember, this thing was used by financial institutions to package asset-backed securities like a mortgage-backed security. And so what we did is that we formed this special purpose vehicle or a special purpose entity, and we put these mortgages in there, and then we issued a bond to finance those mortgages. And that was a pretty fun thing, off balance sheet financing. Well, think of this special purpose acquisition company as being very similar to a special purpose entity with a couple of differences. So this is a separate and legal entity, right? The learning module calls it a shell company. And instead of like a special purpose entity issuing bonds, what this SPAC does is it issues equity, right? And so it raises all this equity capital, and notice the word a blind pool of capital. What that means is that if I form this SPAC, I'm going to say, I'll issue shares to you guys, the investing public, and I'll say, I'm going to use all of your capital to go out and buy a company, right? Special purpose acquisition company. And I'll tell you all about it at some later date, right? That's why it's called a blind pool of capital. And so what do? I raise all of this money, I have it in this SPAC, and then I go out and I try to find companies that are potential takeover candidates. And then I buy into those companies, and then I take over some of those companies, and then somebody else takes over those companies. You see the process goes in kind of a circular fashion. And so all we're going to do is that we're going to provide this capital for some kind of a merger or an acquisition. So what do we like about these things? This SPAC that we create is going to increase the visibility, right? You read the Wall Street Journal every day. There's always an article about a SPAC. So this is going to pique the interest of all of the investors out there, right? Flexible transaction structure, links with high profile and seasoned sponsors, right? There's lots and lots of famous institutions out there that do this all the time. Disadvantages, of course, then are high costs of capital. What did I say just a few moments ago? What did Modigliani and Miller tell us? That the value of any company is the quality of the assets and the weighted average cost of capital here. So that's a big disadvantage. And because that disadvantage then manifests itself into probably higher spreads. And we have to worry about redemptions. We have to worry about overhang. We have to worry about churn. We have to worry about all of these kinds of things. So what we like about this is that we can create an entity that has a special purpose. And that special purpose is to play a role in the merger and acquisition game. What we don't like about it is that there can be super high costs And there can be spreads between what we think, what is, and what's going on in the merger market. We can also have direct listing. The equity of the entity is floated on the public markets without the underwriters, which means that this is going to be directly appealing to the investors. What does that second bullet point tell us? Of course, we know this is going to reduce complexity and the cost of the transaction. What else we can do? We can recapitalize. We can exchange debt for equity. So notice there's leverage in that portfolio company. We can have secondary sales. We can have write-offs or liquidations. I think these 4 and 5 are less important here in terms of identifying the potential exam questions for this LOS. But here's the good one. So right after the section on features, there's a beautiful section on risk and return of private equity, and we'll see that on risk and return of private debt. So what do we like about this? I think these are really, really good potential exam questions. So what is the risk and return profile? So I want you to think just about Harry Markowitz, going back to that efficient frontier. So we still have standard deviation on the horizontal axis. We still have the expected return on the vertical axis. And what are we trying to do? We're trying to push up to that top left corner. Clearly, there's going to be more risk. And the reason that there's more risk is because we're using leverage, right? In all these kinds of conversations in here, this private equity, they're issuing a bond or they're taking out a loan or they're doing something inside of there to buy the equity. So using debt to buy equity. So there's lots and lots of leverage. And then, of course, what that means then is that if we're buying Jim's Honeycrisp orchard, boy, what's the secondary market for that thing, right? So it's not going to be too liquid. So because of that leverage and because of that lack of liquidity, we're going to say something like, you know what, there's more risk, therefore we're going to require higher returns. And these higher returns are the investment in these private companies like Jim's Orchard. And think about it, if I'm profitable with Honeycrisp apple sales, add that to grape sales and then add that to Honeycrisp apple wine sales, then I have all this potential for growth that avoids all of the structure problems and all of the government intervention with publicly held companies. What that also means then is that you guys, as the investors in my Honeycrisp apple farm, maybe you know something about grapes, maybe you know something about wine, and because you have a strong minority or even a majority interest in my farm, you can help me run the business and we can generate higher sustainable operating cash flows in the future. All right, moving on to private debt. What the Institute does in this learning module is go through a couple of different categories. So there's direct lending, and this is exactly what I was suggesting in the very beginning of my story, directly providing capital to the borrowers, right? They are probably senior and secured loans. There are probably covenants in there. High interest rate loans lacking alternatives to traditional bank lenders may involve a leveraged loan. All right, so this is all the stuff that I mentioned in that first simple example. But here's an illustration of what I was talking about, that you're not going to provide me with this capital, private debt, unless a lawyer comes in and says, what are you protected by? So I use my Honeycrisp apple tree as collateral. We have a bond contract that has all these kind of terms in it. So direct lending, that should make perfect sense. A mezzanine loan, on the other hand, these are almost always private credit subordinate debt, subordinate to that senior secured debt. This mezzanine loan is most of the time used to finance leveraged buyouts, which means that they're probably going to expect high returns. but there will be some kind of an embedded option in that mezzanine loan. So it may come with a warrant, it may come with convertibility, it may come with any kind of other embedded option that you can think of. Venture debt, what did I say earlier? Think of venture capital as investing in startups. So here we go, venture capital financing to startups. So instead of providing an ownership to the venture capitalist, right? We're now calling this the venture dentist. A dentist, not dentist with the teeth. So this is probably a line of credit where you say, you know what, whenever you need money, go in and borrow it. But notice at the bottom there, this venture debt, of course, you're doing this with these startup or early stage companies, and you're going to say something like, you know what, if you're ever successful, I would like to convert some of my loans into equity participation. Yeah, I love distressed debt. I think you may remember I had a colleague when I was in graduate school who wrote his dissertation on being able to predict bankruptcy. And one of the side issues of predicting bankruptcy, now these are for publicly held companies, one of the side issues is that when you predict bankruptcy and you bet on bankruptcy, that's a good thing then when the firm goes bankrupt. But what if the firm recovers? And so think about distressed debt of publicly held companies. I mean, you could buy a bond for $200 and it recovers and you sell it for $400. I mean, you double your money there, right? Distressed debt. So the same thing applies here about distressed debt of these private companies. And so you have the opportunity for huge capital gains. This distressed debt, you may remember I said this in a previous learning module, distressed debt, investment in distressed debt looks almost like equity because there's lots and lots of standard deviation. And then there are other private debt categories in there that can take on any different kinds of structures. They can have tranches, they can be untranched, they can be unitranched, they can have all sorts of crazy things in there. Now here's this slide I was telling you about, risk return of private equity. We did that. Risk return of private debt. What are we trying to do? We're trying to, of course, move the Harry Markowitz efficient frontier. Now, remember, just because we learned Harry Markowitz efficient frontier with equity securities doesn't mean we can't apply that same strategy in the Excel solver when we're evaluating private debt. So we're doing the same thing. We're trying to, minimize standard deviation while maximizing rates of return. So what are we doing here with this risk and return? What are we hoping for? We're trying to get diversification, right? So that's going to increase our diversification, reduce standard deviation, that whole conversation about correlation coefficients. But because this private debt market is characterized by things like lack of liquidity and maybe extra leverage in there might be opportunities given those market inefficiencies, because recall what Eugene Fama taught us back in 1970, that any security is valued based on its relevant and publicly available information. Well, if we go into the private debt market, there's still lots and lots of relevant information. It might, in fact, it's likely not to be publicly available information. So those market inefficiencies might provide some extra return opportunities. Now, in this private debt market, we're likely to find some kind of a benchmark that looks like that SOFR rate, right? The secured overnight financing rate. Let's move on to that final LOS, which includes that great word in alternative investment universe, diversification. So what are those diversification benefits of private debt and private equity? So let's go ahead and break them into two categories. Direct investment. What are we doing? We're directly investing into a specific operating company. So that specific operating company has operating cash flows. And so that level of diversification will depend on its performance. Of course, that makes perfect sense. But the stage of that company's life cycle, is it early, super early stage like venture capital, or is it the mature stage like maybe some private equity investments, and all of those associated risks? Now, the indirect investments, of course, what we're doing is investing in this private equity or private capital fund. And so those diversification benefits are going to, once again, depend on that stage. But we need to worry about the difference between early stages and late stages and declining industry. In fact, the learning module has a little bit of an emphasis on declining industry investment, and we need to make sure we worry about that. Not only the economic cycle, but the business cycle and the operating cycle that we did in previous learning modules. Look down in the bottom right purple there, the final bullet point. Hedging performance risk in public equity and debt is relatively easy because there are lots and lots of derivative securities out there that can be used as substitutes. Now, there's a good question at the end of this learning module on the vintage year. And in fact, you get this term vintage from the wine industry. I guess that was a good analogy for my first example. So we need a vintage year. This is a beginning year, right? The year when the fund initiates its initial investment activities. The reason that the vintage year is so important is that we need to have a benchmark, right? Like you could be involved and you could think about this and you could think about this, but when did we have this substantial investment? So that's the beginning date, vintage year. And then, private equity, I think I've said this in a previous learning module, they typically last 8 or 10 or 12 years, sometimes just a little bit longer. And so you can chop those into 1/2. If it's 10 years, you have the first 5 years of which you're doing all sorts of capital commitment and capital deployment. Remember, we had those couple of slides in the previous learning module. What did we say? That, there was, in those early years, there was negative cash flows, and in the middle years, there was kind of zero cash flows. Remember, I said that, even though the Institute doesn't really call it zero cash flows during that term. But then in the harvesting phase, this is when those cash flows turn super positive. So you got negative returns, zero returns, and then, super positive returns during that harvesting phase. So I think it's okay if you think private equity 10 years, just chop that in half, 5 and 5. This is a great exam question, difference between investment phase and the harvesting phase. Notice down there at the purple, we're going to emphasize this concept of diversification once again. And so what does the Institute tell us? Yes, pursue diversification across various vintage years. So this is a cool thing. So I guess you would call this time diversification. So what we'd like to do is invest in one private equity fund that is investing in the vintage, right? And then another private equity fund in which the vintage was 3 years ago, and then another private equity fund in which the vintage was 7 years ago. Some kind of diversification across that, because then what happens? You got, think of these as just different silos. So, you should have one silo with standard deviation, another silo, and you got several silos with different standard deviations. So what does that portfolio effect do? Well, it does it just like Harry Markowitz taught us back in 1952, so you have some kind of smoothing out. But remember what this whole idea is, that we're trying to reduce risk through diversification while attempting to increase returns. Remember, this is super difficult to do, but I promise you that these really smart men and women in this private capital world, they've been super successful. Now, of course, if you read the Wall Street Journal, there have been super failures as well. And I never get political, and I'm not going to now. But go back to a previous presidential election here in the United States, where one of the candidates was involved in a super popular and super successful private equity firm. I'll just leave it at that. You guys can figure out who I mean. All right, so I think this was a good slide deck and a good recording. Features of private equity, features of private debt, and then a continuous conversation on the diversification benefits. So there are, I think, 9 questions at the end of this learning module. You can do these in, I bet, 5 minutes or so. Lots and lots of definitions that we covered in this slide deck. So good luck on that. So thanks for watching. and keep studying. Remember, keep studying no matter what.